Welcome back. I'm Peter St. Honest. This is a weekly roundup of my daily videos on the economy and freedom, where I cut through the BS and lay out what the gaslighting clowns pulled out of their hats this week and what is coming next. The experts were wrong again with a blockbuster job report that beat every metric. Private sector payrolls were up 172,000, which is more than twice what the economy needs. Government jobs actually fell by 40K to the lowest federal payroll since 1966. The unemployment rate dropped, hours worked rose, which predicts future hiring. The number of people saying they're employed jumped by 500,400,000, got off the couch and started looking for work, which is a good sign for the economy, but normally raises the unemployment rate. We got a 450,000 person drop in part-timers who could not find full-time work. Dreaded U6 underemployment, so people who want a job but are not looking, crashed by 600,000. Even manufacturing rose, breaking a 22-month trend that started deep in Biden. The biggest was the average hourly earnings, which grew 5% annualized. That's close to twice inflation. It's actually 6 times inflation, according to Truflation's current tally. Now, last week I had a pair of videos talking about the so-called weak job market, how it was driven by paper factors like federal layoffs, deportations, Biden's zombie green energy going bust, and slower federal spending compared to the Biden orgy. All while job boosters, meaning Fed rate cuts and trillions building new factories, all take time. Well, this job report says we are going from the pain to the gain. Now, it's not all rosy, starting with a massive 900,000 downward job revision by the notorious Bureau of Labor Statistics. Almost all of it fake jobs under Biden. The culprit is the BLS's so-called birth-death model of company formation that uses data from the COVID-era explosion of millions of fake businesses set up to steal federal money they were handing out like candy during COVID, from Somali leering centers on down. The other concern is AI. For a year, I've been predicting a 2-speed job market where blue collars grow from deportations and new factories, but white collars get slammed as AI starts to replace cubicle jobs in finance, consulting, and IT. In fact, last month, finance jobs lost 22,000, down almost 50,000 since last May. IT was flat this month, but down 90,000 since its post-COVID peak. Journalists are down 300,000 since post-COVID peak. Meanwhile, construction was up 33,000 last month, driven by factory construction. Manufacturing tacked on another 5. This Robin Hood job market is a welcome change from 40 years of blue-collar slaughter. Still, considering most American jobs are white-collar, there are millions at risk. So what's next? The job market is picking up and should accelerate with new factories and Fed rate cuts. At the same time, AI job losses should start showing up in the numbers later this year. Not catastrophically. Prediction market Kalshi projects just 1 in 11 odds of getting over 7 on unemployment, but AI will go from hypothetical to real. The question being, can the factories and rate cuts soak up the cubicle refugees, or do we need more from Congress, specifically cutting tax and red tape for small business that employs 62 million Americans, roughly half the population, and could employ tens of millions more if bureaucrats get off their back? Japan's new nationalist prime minister just won a sweeping election, nabbing more than 2/3 of seats, enough to change the constitution. Is it a new day for Japan after 3 lost decades? Last week, Japan went to the polls in a snap election. Freshly minted Prime Minister Takaichi had called them because she's rapidly popular, and in parliamentary systems like Japan, you can call an election pretty much any time you want, meaning you want to convert popularity into seats. Meanwhile, the ruling party needed more seats since they've been running a minority government since October, meaning they had to beg, borrow, and steal from other parties to get anything passed. Takaichi turned that into a resounding majority government that can push pretty much anything. So what changes? The main campaign issues were the economy and inflation, immigration by third worlders, yes, even in Japan, and military, where Takaichi has taken a hard line with China while promising to double military spending, both of which pleased Donald Trump. On the economy, Takaichi is promising tax cuts, including bumping the standard deduction, lower taxes on married couples so Japanese start having kids, reducing the gasoline tax, and her flagship promise pausing Japan's 8% sales tax on food. She's pairing this with massive stimulus, about $1 trillion in U.S. GDP terms, half of which is going directly to households, so electric bills, cash handouts for parents, rice coupons, since Japan's rice prices are exploding. The rest goes to big Japanese companies, especially in AI and semiconductors. Now, markets saw all this as good for growth. Japanese stocks popped 4% on the Nikkei, but bad for government debt, where Japan is by far the highest in the world at 265% of GDP. In U.S. terms, that's about $70 trillion of federal debt. This raises the odds of a bond market blow-up, something I've been warning about in recent videos, since it could crash U.S. stocks via the so-called carry trade. But Japanese bonds actually rose on the election, maybe because markets think Japan's dysfunctional politics could actually fix something. Beyond the economy, third world migration was a big issue. In fact, it's what cost the ruling party its majority in the first place. The background here is corporate Japan loves cheap third world labor. They've been flooding them in to the point some towns in Japan are 1/5 third worlders. As in the West, they commit crime, but they also drag down wages for Japanese blue collars to the point it pays $5 an hour working at 7-Eleven, while there's roughly 5 million Japanese in their 20s and 30s who are not working. The ruling party, who's long seen as owned by big business, recently announced they'll be importing 300,000 third worlders per year through 2040. That's in a country a third the size of the U.S. that is definitely not set up for third worlders. During the campaign, Takaichi talked tough about stricter rules, but she has not taken on the corporations nor floated the mass deportations that Japan needs. So what's next? After 35 years of stagnation, Takaichi's economics are not a radical change. Tax cuts are welcome, but subsidies for corporate zombies prolongs the long stagnation. Her immigration stance is welcome to the 77% of Japanese who want less third worlders, but we'll see if she actually stands up to big business. The best you could say for now is she is giving Japanese hope they have not had in a long time. A word from our sponsor. If you own gold, and many of you do, you already understand how it protects your wealth from the insanity coming out of Washington. The inflation, the recessions, the wars. But with monetary metals, there's a way to actually earn a yield of up to 4% on your gold paid in more ounces of gold. You retain ownership of real, allocated physical gold with no storage costs while your ounces grow every month outside the banking system. If you're serious about protecting your future and building your legacy, head to monetarymetals.com/Peter to get started. Now back to our show. The national debt will hit $63 trillion in just 9 years, including $16 trillion of debt interest. For perspective, 9 years ago is when Donald Trump first eased into the Oval Office. Will we be selling the pets or the kids to keep Somali leering setters in Bugattis? The report comes from the nonpartisan Congressional Budget Office, which is their in-house accountants, who projects $23 trillion of deficits, a cool $2.5 trillion per year, which will take the debt to $63 trillion, which is 120% of GDP, surpassing World War II. Note, that's assuming no recession between now and 2035, which is a bold assumption, considering the Federal Reserve has delivered a recession every 6 years for going on 113 years now. Indeed, prediction market Kalshi currently projects 1 in 5 odds of a recession this year, which is about half what it was under Biden, but still, 9 years is one heck of a stretch. Recession would send the deficit soaring since tax collections crash, but welfare jumps. Going by recent history, a recession would send the deficit above $4 trillion. It is just shy of a gazillion, and that would take us well past 70 in 9 years. What's driving it is not a lack of taxes. Taxes are actually up 50% since pre-COVID. It is spending, which almost doubled, so $7 trillion versus $4 pre-COVID. Setting aside tax hikes, which make it worse because they shrink the economy, there are only two solutions: either cut spending or raise growth. Spending will not cut itself so long as the filibuster gridlocks Congress, which leaves growth. The CBO projection assumes 1.8% real growth, but we're actually doing about 4.4% at the moment. If that keeps up, we can easily grow into $63 trillion. In fact, at 4.4, the deficit shrinks as a share of the economy. So the question is how to keep the current growth. It's harder than it looks. 4.4 is double the growth rate since 2000. Right now, Trump's hitting it with a combination of tax cuts, deregulation, onshoring factories, and AI driving the biggest tech investment boom since .com. But a lot of these are one-off, so if we're talking 9 years, we need structural change, especially if AI is going to start gobbling up cubicle jobs that make up more than half of American jobs. Now, governments are bad at proactively growing economies, so-called industrial policy, which has a bleak track record of picking winners, handing them your money, and then they go bust. But governments getting out of the way has a spectacular track record, meaning tax cuts and getting rid of crony regulations, especially for small businesses who create 5 to 10 times more jobs per dollar than big businesses do. We've got a beautiful natural experiment when both Detroit and Hong Kong lost their manufacturing base to China in the 1980s. Low tax, low regulation Hong Kong quickly replaced the jobs at twice the pay. In fact, Hong Kong today is 3 times richer than it was in 1980. Detroit City actually fell from 40,000 income to just over 20, thank a bureaucrat. So as next, given the spending climate in Washington, growth is the only way we will survive $63 trillion. Trump is hitting the right points, but without Congress, we're still miles from sustaining 3 or 4% growth that we need. Slashing regulations to 1950s levels and eliminating tax on small business would do it, but that is science fiction in Congress. In the meantime, we've got precisely 9 years to fix it. Just like that, BRICS is over as Russia crawls to Trump, hat in hand, begging to rejoin the dollar. 3 years ago, the China-backed BRICS currency was supposed to crush the U.S. dollar by backing with gold, which is kryptonite to paper money. 2 years ago, that collapsed into a clown car where BRICS would instead be a goofy basket of currencies with a hypothetical gold kicker you can't actually redeem. That was the beginning of the end for BRICS, and now Russia finished it off. So the problem is a basket is where you throw all the currencies in a big pot, stir it, and get a BRICS that's 1/5 ruble, 1/5 yuan, 1/5 South African rand, and so on. The problem is these are all crap currencies. Since the 90s, Russia had literal hyperinflation, as did Brazil. Russia hit 2,500%, Brazil hit 7,000%. India and South Africa aren't much better, turning in periodic 20 to 30% inflation. China isn't even freely traded. You need government permission to move it across borders. It can be frozen or seized at will. Beijing literally makes up the value and force by threatening to arrest bankers who disobey. This currency basket turned BRICS from dollar killer to an accounting gimmick for internal trade between BRICS countries, which is less than 2% of global trade. More important, you don't park your life savings in a basket of currencies fresh from hyperinflation, and savings is overwhelmingly where a currency gets its value. BRICS threw it away. Meanwhile, the dollar went from near double-digit inflation in 2022 to, at the moment, under 1% according to Truflation. So BRICS lost the plot, the dollar got its life together. Russia just pounded the last nail in the coffin. So Russia's angle is the dollar remains the best payment rail in the world and the best store of value outside gold. So rejoining the dollar lowers transaction costs in international trade, which stabilizes the ruble. Russia's move is also interesting because it suggests that Putin is more worried about Chinese dominance than American dominance. Of course, Trump hates giving other countries something for nothing. Russia knows this and is dangling joint investments in natural gas, oil, lithium, and rare earths to displace China, along with deals to buy billions worth of American airplanes and a unified stance against green energy, which benefits China, who makes the wind and solar, but hurts Russia and America, who are swimming in oil and gas. So as next, the dollar got a stay of execution, but it is not out of the woods. Because the threat is not BRICS, it is gold. Central bank gold holdings just passed dollar holdings for the first time since World War II. In other words, it's not the dollar in danger, it's paper money in danger from trillion-dollar deficits in every major economy, including China. The trigger is bond markets failing to digest more than $10 trillion of government debt refinancing this year, which would skyrocket interest rates and force central banks to print, baby print, which causes inflation. This happened in Britain a few years ago, the so-called Liz Truss moment that threatened to bankrupt the entire British banking and pension system. Japan flirted with it a few weeks ago, and with $2 trillion deficits, the new normal in Washington, it is coming here next. A word from our sponsor. One of the best ways to secure your Bitcoin is with a hardware wallet, a physical device that lets you keep your coins offline without internet connection. One of the most trusted names in hardware wallets is Kite, maker of the famous block clock. Kite devices are made in Canada and they're run by passionate Bitcoiners who've been at this since 2012, back when Bitcoiners were trading in person at swap meets. You can pick up hardware wallets and plenty of other goodies at coinkite.com/ProfSaintAnge. That's COINKITE.com/ProfSaintAnge. Okay, back to our show. So-called experts predicted inflation would soar under Donald Trump. Instead, it crashed. Prices are still high, of course, but we are flirting with deflation. So why were experts so wrong? Was it pure bias? Or are left-wing Keynesian models garbage? Before the 24 election, CNN ran an open letter by no less than 16 Nobel economists, that's 1 in 3 living laureates, warning that inflation would rise under Trump from the 3% it was running at the time. In fact, inflation went dramatically down under Trump. It's currently running 2.4 year on year, but it's actually under 1%, according to real-time aggregator Truflation. So where did they go wrong? Their argument was tariffs would be passed on to consumers, which did not happen in Trump's first term, nor his second. In fact, the Chinese ate the tariffs. But the big one is their model said Trump would grow the economy too fast, namely that $4.8 trillion of tax cuts in the big, beautiful bill, along with deregulation, would, quote, risk accelerating the economy when the Federal Reserve is working hard to slow it down. As in, the Fed was dutifully strangling the economy, but President mean tweets would make it grow too fast. So in standard Keynesian, there's a trade-off between growth and inflation called the Phillips curve. It says if the economy grows too fast, you get inflation. It supposedly overheats. So the solution is strangle the economy after you print it a bunch. So this is garbage because classical economics and Austrian economics says productive growth reduces inflation. It's the unproductive government spending, Somali leering centers, windmill subsidies, welfare for illegals, those are what cause inflation. So Keynesians can't see this because they're correlating GDP, and government spending perversely is counted as GDP. So statistically, it is garbage in, garbage out. To see why production lowers prices, imagine a big pile of all the money circulating as in exclude savings, which are salted away for a rainy day where they don't chase prices up. So big pile of circulating money, and then take all the stuff for sale in another pile. Divide them in presto dollars per stuff. Money is growing faster than stuff. There's too much money and prices go up. But if stuff is growing faster, it takes fewer dollars to buy a widget, presto, prices go down. That's exactly what's happening right now. M2 money supply is growing at 4.5%, but productivity is growing at 4.9%. So the money's growing slower than the stuff, which is what's trending us towards deflation. Now, the reason that M2 is slow is federal spending is growing at just 2% compared to 11% in Biden's last year. Beyond explaining why inflation came down under Trump, this also explains why left-wing economists and politicians actively try to strangle the economy. So in their mind, they think strangling the private economy leaves more inflation for government to spend, but in reality, they're shrinking the entire pie and making total inflation worse, also known as stagflation. Of course, for them, government spending is the only reason to have an economy in the first place, so even if they did understand that government drives inflation and stagnation, they don't much care. Government spending is the goal. So as next, the growth drives inflation story has been wrong since Milton Friedman savaged it in 1967, but socialist universities and socialist Nobel committees keep pushing it to grab more of the productive economy for the government who pays them, while the collateral damage, the inflation and the strangled wages, hits other people, especially blue collars they probably enjoy seeing suffer. Thanks for tuning in. Remember to subscribe so you don't miss an episode, and go to petersanons.com for daily videos and in-depth articles with charts and all the gory details. Okay, we'll be watching. See you next time.